It is currently Sunday, December 7th, 2025. The markets are closed, so we are looking at the closing data from the last active trading session. Pure Storage Inc., ticker symbol PSTG on the New York Stock Exchange, finished the week at $70.43 per share. The stock took a hit in the final session, dropping $1.77, which translates to a decline of 2.45%. If you are just tuning in or checking your portfolio, that red number might feel like a sting, but the broader context here is far more volatile and fascinating than a simple single-day drop. You are likely here because you have seen the headlines or felt the volatility in your own account. The expectation for Pure Storage has been nothing short of sky high. The narrative sold to investors for the last 18 months was that Pure Storage is the silent engine behind the artificial intelligence boom, the company providing the high-speed, all-flash memory specifically designed to feed the insatiable data hunger of NVIDIA's GPUs. The expectation was that as AI factories scaled, Pure Storage would see a linear, perhaps even exponential explosion in immediate profits. That was the dream. The reality, however, has delivered a complex, jagged pill to swallow. While the company is indeed growing and securing massive wins with hyperscalers, the timeline for that payoff has been pushed further out, and the costs to get there are rising. Investors who expected a quick up-only chart like NVIDIA stock in early 2024 are realizing that hardware infrastructure plays are capital-intensive and cyclical. This tension between the undeniable long-term demand for flash storage and the short-term pain of margin compression is exactly where we find ourselves today. Let's strip away the noise and look at what is actually happening on the charts and in the boardroom. The recent price action has been brutal for short-term holders. We just saw a massive correction following the Q3 earnings report released earlier this week. The stock had run up to near $100, priced for absolute perfection, trading at multiples that would make even a Tesla stock bull blush during a frenzy. When Pure Storage released their numbers, revenue of $964.5 million, up 16% year over year, it was good. In fact, it beat estimates. Earnings per share came in at 58 cents, matching what the smart money on Wall Street expected. So why did the stock crater 26% in a single session before stabilizing at this $70 level? The answer lies in the guidance and the spending plans. Management effectively told the market, we are growing, but to capture the massive AI opportunity, we need to spend heavily on research, development, and sales right now. They signaled that fiscal year 2027 would be an investment year. In the world of high-frequency trading and quarterly capitalism, investment year is a code for your margins are going to shrink before they get better. This triggered a massive sell-off. Retail investors using Robinhood stock trading apps likely saw the red tape and panicked, dumping shares alongside skittish momentum funds. Meanwhile, more patient capital, perhaps those managing their own retirement via Fidelity IRAs or utilizing Schwab Intelligent Portfolios, might be looking at this $70 level not as a disaster, but as a reversion to sanity. To understand why this reaction was so violent, you have to understand the specific mechanical shift Pure Storage is trying to execute. They are trying to kill the hard disk drive. For decades, data centers have relied on spinning magnetic platters, hard drives, to store the bulk of the world's data because they were cheap. Flash storage, which Pure sells, is faster and more energy efficient, but historically more expensive. Pure's thesis is that the cost curves have crossed. They argue that when you factor in electricity, cooling, and space, especially in the power-hungry age of AI, flash is actually cheaper than disk. This is a massive claim. If they are right, they don't just win a slice of the market, they replace the entire foundation of enterprise storage. But convincing a Fortune 500 CFO to rip out their cheap hard drives and replace them with premium all-flash arrays takes time, and it takes an army of expensive salespeople. That is where the money is going, and that is why the stock took a hit. Let's look deeper at the numbers that came out this week. Subscription services revenue grew 14%. This is the golden goose for any modern tech company. They don't just want to sell you a box once. They want you to pay for a subscription to manage that data forever. This is the model that turned Adobe and Microsoft into trillion-dollar titans. Pure's subscription business, largely driven by their evergreen model, is growing, but it grew slightly slower than total revenue. This spooked the market. Investors love the predictability of subscriptions. If the hardware sales, the one-off boxes, are growing faster than the subscriptions, it introduces lumpiness and unpredictability back into the model. It makes the company look more like a traditional hardware vendor, like Dell or HPE, and less like a high-flying software-as-a-service play. And hardware vendors do not get to trade at 100 times earnings. However, if you are sitting there with your SoFi Invest app open, wondering if you should cut your losses, consider the counter-argument. The partnership with NVIDIA is not just a press release, it is an architectural shift. NVIDIA's new superpods for AI require data to be fed to the chips at lightning speeds. If the storage is slow, the expensive GPUs sit idle, waiting for data. That is a waste of money. Pure Storage has certified its FlashBlade systems to work seamlessly with NVIDIA's DGX systems. This means they are the approved plumbing for the AI factories of the future. The drop in stock price this week is largely a valuation reset, not a broken business model. The company still has $1.5 billion in cash and investments. They are profitable. They are buying back stock. This isn't a speculative startup running on fumes. It's a cash-generating machine that just happened to get too expensive for its own good. Now, let's take a step back and look at the broader landscape of how people are actually buying this stock. You have a distinct divide in the market right now. On one side, you have the algorithmic traders and the momentum chasers who operate on platforms like interactive brokers using complex leverage and options strategies. They saw the guidance, their models flashed sell, and they dumped the stock instantly to protect their monthly P&L. On the other side, you have the buy and hold crowd, people perhaps using Fidelity Wealth Management Services or just managing their own individual brokerage accounts who are looking at the 5-year horizon. For them, the question is, will data storage needs double, triple, or quadruple by 2030? The answer is almost certainly yes. AI models are getting larger, not smaller. The amount of data generated by autonomous vehicles, smart cities, and genomic sequencing is exploding. All that data has to live somewhere, and it needs to be accessed instantly. This brings us to the company's core technology, which is often misunderstood. Pure Storage doesn't just buy flash chips from Samsung and stick them in a box. They write the software, the Purity operating system that manages those chips. Flash memory wears out. If you write to it too many times, it dies. Pure software is incredibly efficient at spreading that wear and tear, making their drives last longer and perform better than generic off-the-shelf SSDs. This allows them to use cheaper, consumer-grade flash memory, QLC, but get enterprise-grade reliability out of it. This software advantage is their moat. It's why they can claim to be more energy efficient than competitors like NetApp or Dell. In a world where data centers are consuming significant percentages of national power grids, energy efficiency isn't just a buzzword for an ESG report. It is a hard economic necessity. A data center operator will pay a premium for storage that cuts their electricity bill by 20%. However, the competitive landscape is fierce. You cannot talk about Pure without mentioning the giants. Dell Technologies and NetApp are the incumbents. They have massive installed bases and deep relationships with IT departments. For a long time, they dismissed all-flash as a niche for high-frequency trading or premium databases. Now they see the threat. They are rolling out their own all-flash arrays and aggressive pricing strategies. Dell, in particular, has been bundling their storage with their servers and laptops. using their massive scale to squeeze Pure. This is why Pure has to spend so much on sales and marketing. They have to fight for every inch of market share against rivals who can afford to lose money on a storage deal just to keep a customer in their ecosystem. If you are using Robinhood fractional shares to dollar-cost average into tech, you need to understand the macro environment that Pure is operating in right now in late 2025. Interest rates have likely stabilized, but they're not at zero anymore. This matters because storage arrays are expensive capital expenditures. When interest rates are high, companies delay upgrading their hardware. They try to squeeze another year out of their old gear. This sweating of assets slows down revenue growth for companies like Pure. We saw this play out in 2023 and 2024, and it remains a headwind today. The bet you're making with Pure is that the need for AI infrastructure is so urgent